Worldwide Denver's the meetup. If you haven't joined, please do join us. Started this whole thing just to take advantage of the market in Denver and how hot it is and all the great things we got going on here. We're four season sporting, outdoor sports, winter, biking, hiking, camping, so we got it all. All the sporting activities. Some people like to think the top 4 are the best, but we got probably the top 5, 6, depending on if you want to count the lacrosse and rugby. Today we're going to be talking about some things. I just want to make the standard disclosure. We're not your attorney. We're not your accountant. We're not giving you investment advice. Please investigate all matters on your own. And if you have any questions, take that to your professionals. So Western Investor Network and Prologic Capital are with you today. I own Western Investor Network. We're a small boutique commercial brokerage. We do really everything commercial. Somebody walks in the door wanting to do a commercial deal, we want to help them do that. So we do acquisitions, dispositions, tenant rep, landlord rep. We do property management on the commercial side. We do not do residential or multifamily management by choice. We do hard money lending, non-performing note work, so really anything. We have vendors in line that we don't do in the house. We certainly can get names on all that. So speaking about syndications, with us today is going to be Stan with Prologic Capital. And I'm going to turn it over to Stan at this time and let him run through it.
Sure. Hi, everyone. Good afternoon. My name is Stan Wood. I have a company called Prologic Capital. Essentially what Prologic Capital does is I invest in off-market commercial real estate deals. I do off-fee simple deals, value-add deals. I also buy a lot of distressed and non-performing, sub-performing commercial real estate loans. So today, I thought we'd talk a little bit about real estate syndications. To do so, I thought first we'd just take a look at the overall investing environment that's out there. You know, all asset classes compete for capital in the investing environment. Bonds compete with equities, equities compete with bonds, and bonds and equities both compete with alternative investments. Some of those alternative investments I have listed here today are oil and gas, and we know buying oil and gas and investing in oil and gas can be pretty volatile. There's fine art. I told somebody the other day I painted a Picasso over the weekend and sold it yesterday, so that just stays here in the room. Commodities, again, that could be oil and gas, it could be wheat, corn. There is FX currency. I heard something interesting today on the financial channels, and that is the foreign investment demand for 10-year government treasuries is dropping. And the reason it's dropping is because the foreign investors don't like the current currency rates. It makes it more expensive to invest in the T-bill. So funding the government might be getting a little bit more expensive. Futures and derivatives, of course, futures could be currency, derivatives. You know, Warren Buffett called them the financial instrument of mass destruction. It's simply what really took down the market in 2008. And then we come to commercial real estate, and more particularly, we're here to talk about syndications today. So these are some of your major alternative asset classes that investors can look to invest in and try to diversify their portfolios. Any particular asset class may be more or less attractive due to current business cycle, where we are in the business cycle, macroeconomic conditions, what's going on with the Federal Reserve, which kind of dovetails into a couple of these other ones, inflation expectations, current interest rates, exchange rates, global economic conditions. Right now we see a synchronized global recovery. It seems like everybody's doing well across the globe, which is a little bit different than it has been historically. And then of course we have the political environment, what's going on not only in this country, but what we see in other geopolitical risk out there. North Korea obviously comes to mind. Obviously, we're having an election later this year, so that may change the investment environment. We don't know. So once we take a look at this, we said, well, what is a real estate syndication? I just have a little definition here that I came up with. A real estate syndication is where several investors pool their capital resources to collectively purchase a real property asset, so to realize the particular benefits associated with real estate investments. So essentially, a group of people come together, they pool their money, and they buy a piece of property. And that piece of property is typically governed and dealt with by the manager who puts the group together. Here's some of the advantages of the real estate market, why maybe syndications in particular. The advantage to commercial real estate is you may have cash flow, you can have capital appreciation, you can have depreciation, you can have leverage if you decide to put financing on a property, have equity buildup if the property is financed. And I think this is a really important point. A hard asset has intrinsic value. You know, a stock can go to zero. A bond can lose a lot of money, as can a piece of real estate, but it has an intrinsic value. It's land and it's brick and it's steel and it's going to have some value. It's never going to go to zero. It may decline, but it won't go to zero like a stock will. And you have diversification. You know, in syndications, I was talking with someone earlier, you know, you may not have enough money to completely go out and buy $1 million property yourself yet, but you're probably going to have the money that you can put into a real estate syndication and diversify. You can diversify across your portfolio, and you can get some of the benefits you have here. Again, that's participation. You can participate in the investment. Some of the disadvantages of real estate's not very liquid. It takes a little bit time to sell. As I learned earlier in my career, flipping commercial real estate can be difficult. It's not like a house. It sits on the market a little bit longer. Capital markets, excuse me, that can be a risk. You know, maybe the capital markets dry out. There's not a lot of available financing. And of course, like everything else, you have interest rate risk. So when you form a syndication, a real estate syndication, here are the steps that we typically go through to form the syndication. First is you identify the property. What kind of property do you want? Do you want an office building, industrial building, self-storage? There's a variety of asset classes that you can choose from. Second thing is you got to choose a managing member. Then you're going to form the limited liability company, and this is what I call the operating LLC. And that operating LLC is going to own the asset. And as the investor, you're going to own a share in that operating company. You're going to determine the structure. Now, I don't want to get too far into the weeds here today, but the Security and Exchange Commission says that every security, which syndication is, has to be registered with the Federal Securities and Exchange Commission, unless it falls under one of the exemptions. And real estate typically falls under Regulation D, 505, 506, 506C. We'll get into those a little bit later. And next step would be to draft a private placement memorandum. That's a PPM. Some of you may be familiar with another word for it is prospectus. And then you want to manage the entity and the investment. And then finally, you're going to sell the property disposition. And then the final step in the life cycle of the syndication would be the entity dissolution. So the first step here is to identify the property. You know, as I said before, every property has particular attributes and drawbacks. So you want to buy a property that investors have a preference for. Some investors don't like office buildings, some investors do. Some investors prefer industrial buildings, some may prefer a specialty asset like a hotel or something of that nature. So then you also want to take a look at what your investment objectives are. And is your investor looking to get cash flow from this investment? Are they looking to get depreciation, appreciation? Some investors will look at deals and say, well, the biggest benefit I'm looking for is tax advantages. I don't really care about the cash flow as much, but I want the tax advantage. One type of property that might be a development project. And then you want to take a look at the manager's experience. Do they have experience in doing these type of investments? Have they been an investor? Do they maybe have money in the investment along with you? And then again, you want to take a look at the overall macro market and make a choice on the asset that you think has the best chance to appreciate in the market. You don't want to look at an asset, for example, that's going down in value. You want to hopefully time the market to where your asset will appreciate value. Or if it's an add value type of property that you think you can get some appreciation through momentum in the marketplace. So most of you are probably familiar with this. This is how you underwrite a commercial property. You're going to do the underwriting when you identify a property. You're going to look at the market comparison approach, and that's when you just look at similar properties, and you determine what similar properties in a similar location are selling for. The cost approach, that's a little bit different. Sometimes we call it pound per pound value, and that's when you look at, well, what's the value of the land? What's the replacement cost of the property? What would it cost to buy new? And then you know pretty much what the property is worth on a pound for pound basis. And then you have the income approach, and this is the preferred metric, probably when you're doing a syndication. Most investors are probably going to go into a syndication with the hopes of getting income and some appreciation at the end of the life cycle of the asset. So here we just did a quick example of the income approach. Here we have an industrial property, purchase price is $720,000, 10,000 square foot, rents $10 a foot, triple net, and then you see we are leveraging the property at 50%, interest rate at 6, amortization at 20 and a 10-year term. So we have this $100,000 worth of income. You're going to take a little bit of a credit loss. You know, last month when we had this meeting, I heard some comment from the group that, well, wonder if you don't have any vacancy. Do you need to take a vacancy loss? I think you do, because any lender is going to impute a vacancy loss on any property when they underwrite. So this gives you an effective rental income of $95,000. Then you got other income here. That could be laundry or vending machines or something of that nature. Gives you a gross operating income here of $96,000. I did a 25% expense ratio based on gross income. This gives you a net operating income of $72,000, less reserves or capital reserves. Gives you an unleveraged cash flow before tax of almost $70,000. Then if you put some leverage on here, you're going to have annual debt service. That's what that is. Gives you cash flow before tax leverage of a little bit over $38,000. Is there any questions so far? Anybody have any questions?
Well, I got one.
All right.
If I can jump in here.
You bet.
You talked about the SEC guidelines, and you know, in my history, I've done what I consider some syndications, but more as a partnership. What are the differences in those? Three of us friends get together. It's not like I'm soliciting for money, which then would fall under the SEC guidelines. But didn't delve really into a partnership. Is that considered a syndication, or is that kind of a loosely worded?
Sure. Well, that's a good question. If you have a syndication, or if you have a partnership that's going outside and trying to raise funds from the general public, the SEC considers that a security and would have to fall under one of the exemptions. But if you put together an LLC and the management of the LLC is with the members, I think a lot of us in here have formed LLCs and have seen that the check in the box that says management will be with members. And then if your operating agreement also has the management with the members, say you have votes on everything and basically the members are managing the LLC, then it's not a security. That's a good question. So our next slide here is underwriting continued. You know, there was a lot of discussion last month about cap rates. Essentially, a cap rate is just an unleveraged yield. Equity dividend rate, that's cash on cash. Internal rate of return is yield while each dollar invested remains in the investment. This is really what most sponsors look at, because at the end of the day, most everybody is a yield investor. You want to know what your yield is. So on this particular example I gave of investment performance over a 5-year hold period, the acquisition cap rate was a 10. We hope this may be a value add property, so we dropped the exit cap rate to a 9. So we had the first year equity dividend unleveraged at 9.7, and the first year equity dividend leveraged at 11. And there you see your IRR unlevered, and you see your IRR levered. So that would have been a pretty good investment to get into. So your second step here would be you need to choose a manager. This is the guy that's going to manage the day-to-day operations of your group. So you hope your manager has experience in investing in commercial real estate, and this isn't the first deal they've done. You want to look at a track record. That tells into a track record. One of the biggest, I go to a lot of investing conferences. I go to some in New York on Wall Street. And this is the biggest thing they always talk about. What's their track record? Have they done this before? How well did they do? Not too many people are out there looking to invest with a first-time guy. So your managing member here, you want a managing member also that's just not one person. The managing member LLC will have a life of its own. It will have a perpetual life until it's dissolved. But the people that are managing it, you hope it's just not, say, Tony or just Stan. If something happens to Tony, what happens to the group? So you hope that there's more than one guy around to manage the group in case something unfortunately happens. And your manager has a fiduciary duty to the investors. has a duty of loyalty, he has a duty of care, he has a duty to use his best efforts in the investment. So the fiduciary duty that a managing member has is taken very seriously by the SEC. This is something that some people don't look at, but it's really something that if the SEC ever gets involved, they pay a lot of weight. They give a lot of weight to the fiduciary duties that a manager has. And then obviously, your conflicts of interest. Does your manager have a conflict of interest? The rules by the SEC have said that when it comes to management groups, any deal that's offered to the manager, whether the syndication or whether the investment group can do that investment or not, whether they have the money, whether they can do it or not, it has to be offered to the group first. So in these two issues, conflict of interest and fiduciary duties, the SEC watches closely, and it's really a big deal. It's a big deal with the attorneys who specialize in these kind of investments. Really important. The operating LLC is going to own the investment. You guys, if you're in the syndication, you don't own the investment. The operating group owns the investment, and it is governed by the operating agreement. What you own, or what you're going to own, are shares in the company that are outlined in the operating agreement. Shares are personal property. It's not real property. So if you look to sell your shares, those kind of issues will be covered in the operating agreement, but you can't 1031 shares in a syndication. The syndication can 1031 the property, but you can't 1031 your shares in the operating agreement. So again, that's personal property. The operating agreement will cover investor capital accounts, share issuance, how shares can be transferred, distributions, cash flow distributions, how, when. Typically, distributions are made in a real estate syndication on a quarterly basis, but it's typically up to the manager to decide when those distributions are made. And then finally, you have reporting. Again, the manager will report to the investors quarterly and sometimes annually. Typically, you'll have an annual meeting. And then I just again want to get into these SEC exemptions. Again, it's kind of getting down into the weeds, but I think it's important that investors have at least a working knowledge of these exemptions. It says here, all investment vehicles offered to the general public must be registered with the SEC, where individuals are led to invest money in a common enterprise with the expectation that they will earn a profit solely through the efforts of the promoter, sponsor, or someone other than themselves. And if you're going to have one of these and fall outside this regulation, right here, you have to fall into one of the 4 Reg D exemptions for securities, and that's these Reg D requirements. So to make it simple, I just did this little table here that people can look at, and we have copies of this that will be emailed to you. But Reg D, 504, 505, 506B, 506C. Most real estate syndications are going to fall under 506C, where they can raise an unlimited amount of money. Accredited investors, who here knows what an accredited investor is? You have an idea? Okay. Well, an accredited investor is someone that the SEC doesn't believe needs a lot of babysitting. You're wealthy. You should be a knowledgeable investor. And the SEC says if you make over $200,000 annually, and you've done so in the last 2 years, you are an accredited investor. A couple who makes over $300,000 a year for the last 2 years would be considered an accredited investor. But on both sides, if you have a net worth of over $1 million, you're considered an accredited investor. They make this distinction because under non-accredited investors, that's the general public who the SEC really tries to protect. These are the mom and pop guys who may not have high net worth, and the SEC feels obligated to really protect those type of investors. Solicited, accredited investors, on the other hand, the SEC thinks you know what you're doing. You can underwrite an investment yourself. So we don't need a protection. So again, most of the real estate investments are going to fall under 506C. Here, under 504, you can only raise $1 million. That's a little on the low side for a lot of commercial real estate investments.
Crowdfunding.
Crowdfunding. If anybody wants to talk about crowdfunding, I can talk a little bit about that also today. But this just gives you a short, quick, down and dirty on the Reg D requirements. And again, you don't have to get into securities laws, but you should at least be aware of these exemptions. So, step 5 is the private placement memorandum. And the private placement memorandum issues, or prospectus, if that's what you want to call it, is to provide investors with full disclosure regarding the offering. The PPM is prepared by experienced legal counsel with adherence to Guideline 5 of the Securities and Exchange Act, which was issued by the Federal Securities and Exchange Commission. Again, this is a really important document and needs to be read in its entirety and studied by an investor. For you guys, I brought here an actual PPM that was used about 7-8 years ago. It has the PPM, it has the operating agreements, and it has a lot of the other documents that we're going to discuss here today. So you can get a little feel of what one of these things look like. They're pretty involved, so I thought I'd just pass this around. You guys can take a look at a real one there. So once you've formed your PPM, you go on to your next step, and then again, the PPM has 3 major sections. Basic disclosures, such items as formation date, termination date, the description of the property, sponsor, compensation, and conflicts of interest that might exist with the manager. You have a legal agreement, you're going to have your operating agreement, capitalization of the groups. That's basically how much money you guys are going to try to raise. A lot of PPMs call for what's called a mini-max. And a mini-max is once a minimum amount of money is raised, you can break escrow and the fund can start investing, or the syndication can start investing. For example, you could have $1 million minimum raise, and once you hit that $1 million, the fund would break escrow. That means you can start putting money to work, maybe find a property if you haven't already done. Then maybe a maximum of $5 million or whatever the offering is. And then finally, towards the back here, and you'll see this in the back, you have a subscription agreement, and that's basically what the investor fills out and attaches his or her check to. And you have a offering questionnaire, which is something the SEC requires because it determines investor suitability, meaning are you an accredited investor? You know, you have to fill something out that shows that you might be an accredited investor, maybe you're not an accredited investor. It also looks at such issues as what's your experience in investing in commercial real estate. So I just want to touch on this briefly. Here are the tax considerations you might want to be aware of. And that is, your operating LLC is a pass-through entity. It is not going to file a tax return. It will file an informational return. What you will receive as an investor is a K-1, and many of you in here, I'm sure, have received K-1s. It's going to show your pro rata share of the income and loss. The Internal Revenue Code considers most real estate syndications as 1231 real property capital assets. What that means is your investment is going to receive depreciation, cost recovery. It's going to be eligible for capital gains treatment and a variety of other things that go along with the benefits of commercial real estate. But to receive the 1231 tax treatment, you have to hold the property for a minimum of 1 year. And then you have the passive loss rule. Some of you are aware of the passive loss rule. And it says when you give passive income, if you have a passive loss, you can't take that loss and net that loss against any other passive income that year. You have to wait a year to net any passive income losses against any other passive income gain. But if there is a passive income loss at the sale of the property, you can net that passive loss against the profits in the sale. So step 6, again, is your investor and your sponsor splits. Yeah, I'm sure a lot of you are wondering, well, what does the sponsor get out of this? Well, a lot of times they'll get acquisition fees. Sometimes they'll get 2 to 3% of a commission based on the value of the property that they purchase. You'll get formation fees sometimes. They'll charge you for the time and expense that they've undergone or went through to form entities. Sometimes you'll see these, sometimes you won't. Sometimes, you know, it just depends on the offering. There's so many different types of offerings out there, and they structure the fees in multiple different ways. You will probably almost always see an asset management fee, and that's usually 1 to 2% of assets under management. Management management will typically get a share of operational cash flows. Often, we'll see the next slide is what's called a waterfall. That's the most typical structure. And it'll get some kind of percentage of the reversion, the sale proceeds, the net sales proceeds. So again, is there any questions, or anybody just want to break in and ask a question? Feel free to do so. Sure.
Just as a rule of thumb, if you're talking about, say, a $4 million property, like how many investors do you think you would need to pull that off?
Well, different funds, again, are structured different ways,
Okay.
but often, what's frequently you'll see is a minimum buy-in into the fund of $100,000.
Okay.
So you could have 40 investors. Usually in a PPM, you'll have a limit of how many shares you can buy. We don't want an investor that has 51% of the fund. They could control the fund then. So usually it'll be about 20%, I think, is pretty common. The max is around 20% because past that number, if you do go to put leverage on an investment, the bank's going to want to see that investment.
So I have another question. If you, like for properties of different values, say if, I don't even know what you could buy in this market for like $1 million or 500,000. But is there a rule of thumb for like what the property's like going to sell for or worth that determines how many investors maybe you would want to have in a property so you're not like overloaded with people?
Right. That's a good question.
I think you'd have to factor in the debt too. Are you paying cash for that property, or are you
Well,
going to have
each
debt
one of
from
these
investors?
people, like, say if it's like a $2 million piece of property, I don't know what your debt ratio needs to be. 20% down, 10% down, what's required?
Yeah, you're
That
probably
would
at least
probably
20, I would say
qualify
25%
To
down.
some extent, what you would require of everybody. So if you're requiring 25%, say, and it's a $2 million property, so then 25% of that is going to be, what, 50,000? 500? Okay, 500. So then everybody has to come with at least $500,000.
No, that 25% would be your lending, so if you were going to put debt service on or leverage that investment. So as Stan had said, you probably want to put some type of minimum on it, like $100,000, and then a maximum of 19% or 20%, because you don't, if an investor has 20% more, and he said the bank's going to want to see them, basically
Okay.
going to want to sign on the debt. And as an investor in a fund, I'm probably not going to want to sign on the debt. Maybe they would. Personally, I don't think I would want to sign on the debt unless I was running the fund.
So, okay, so then, my next question is, you have to get an attorney, right, to pull this deal off. And then, what's your time factor? Because normally when you buy real estate, people want to know. They don't want to take it off the market. So how does that work with all this?
Well, how it can work is you can form the fund beforehand, before you identify the property. So you get 4 guys together and say, well, we want to go invest in.
Okay, so
Industrial
you get
property.
your
So you can form
people
the fund.
first, and then you start looking.
You could. That's one way you could do it.
Okay.
The other way you could do is you could identify the property and then go and form the fund. So
Well,
I would
I've
know.
known about things like that.
Right, so you could put it under contract, you could put the property under contract if you did something like a 60-day due diligence period, if you're fortunate enough to do that. Hopefully you can get an attorney. We've had attorneys be able to form these in 3 weeks. So hopefully you could get the money together. Hopefully you know the investors you're going to market this to, or is going to provide the capital
Okay.
before you do that. But you could, theoretically, you could form the company in 3 weeks, the syndication in 3 weeks.
Pretty quickly. You might be able to push them a little bit on that. And sellers, as you had mentioned, they're getting wise to tying up their property, going through the due diligence period and trying to fund your money. So, if they know it's a syndication, they might give a little kickback on that. You might have a hard time tying up that property, unless you can show to them that you have your investors trained and it's guys you've done business with, you're ready to go, just need a set of docs, and we'll do that in conjunction with our due diligence period.
It also ties into that, if it's a value-add property, if it's a distressed property, if it's an REO property, your seller's probably not going to get too excited. If you have enough earnest money down, and you have enough experience, they look at your resume, they look at your track record, and they feel pretty comfortable you're going to be able to raise the money.
Okay.
So, one of the things I will tell you is when you form these things, you're looking at about $15,000 minimum for an attorney up to, I've heard nightmare stories up to over $60,000. Those are bigger offerings. Here's a waterfall. This is what's called the most common structure of breakdown between what the sponsor gets and what the investor gets. Investors usually get some type of priority return on cash flows. Sometimes that's called a pref. For example, let's say you got an apartment building that's cash flowing every month. The investors might get 6% of the initial cash flow. And then the sponsor might get, say, 4% of the cash flow. So if the property's, let's say if it's cash flowing 10%, the investor would get 6, sponsor might get 4. Anything over and above, say 10% on cash flows, might get split between the investor and the sponsor on a 70-30 basis. 70% obviously going to the investor. Again, you can do just about anything here. You can make it 80-20, 90-10. I've done a couple that were 60-40. Usually depends on the property and just how good a deal it is. Because if you get in there and you get a really, really good deal, and the sponsor thinks you guys are just going to make a killing, he's going to want more of that than if it's, say, you guys go out and buy an apartment building at a 6 cap. So to sell the property, the investor receives a return. The investor receives a return of their original investment, and then you might again have a 70-30 split between the investor and the sponsor of the net proceeds. What's good about this structure is it aligns the investor and the sponsor. The sponsor wants the thing to cash flow. That's how they get paid. They get paid after you. So they're going to do everything they can to add value and push those cash flows. And on the sell of the property, the sponsor is going to do everything they can do to get the sell price of the property up, because that's how they really make their money. So this way, you guys are aligned with your sponsor. So I just want to, let's see, I went backwards. So just a final word. Again, I really want to stress that the sponsor has a fiduciary duty to you guys, the investor. They have to use the best efforts on the client's behalf, not act in any way contrary to the client's best interest. Exercise all due care and diligence at their disposal on client's behalf. They have a duty to disclose material facts, and they have a duty of loyalty to the investor to avoid any conflicts of interest. So that was a really broad overview of the real estate syndication process, but I think it gives you an idea of the steps involved and the benefits that may come along with real estate syndication. Diversification gives a lot of people a chance to invest in real estate and do so in a way that they can diversify over several property types and also diversify away from maybe more traditional investments like bonds, which, you know, who knows what's going to happen with bonds, with interest rates, securities. We've seen what's been happening in the market the last few weeks. So this is a good way to diversify in your portfolio and also get a little bit more experience in commercial real estate investing. So with that, sure.
Okay, so say there's 10 people and everybody kicks in $100,000. Okay, so the price of the property is $1 million. So are you responsible for, because you said that you don't actually own the property, you are part of the agreement. So as part of the agreement, do you commit to the entire debt, or are you only responsible for that portion of the debt that represents your portion of the ownership?
Typically, what I've seen happen out there is the sponsor will sign on the debt, and the group is a single asset entity backed by the asset. So the bank could look to the asset, only to the asset in the event of default.
Okay.
Right? They could look to the manager, because the manager signed on the debt. It's a recourse loan. And when you have a manager who signs on a recourse loan, typically the manager is going to charge a point for that. Charge a point for the signature.
Okay, so say the property is sold and it generates $500,000 and the manager gets nicked for whatever he gets nicked for. Who pays the rest of it?
Gets sold at the end of the holding period?
Well, the property is sold, but it only generates half of what you paid for it. And then you have the manager who pays whatever share he's committed to. Who picks up what the rest of the loss is? Is that divided?
The $500,000 loss?
Yeah, is that divided among the other people that
No,
are,
well, it depends. It would depend if there's a $500,000 loss and you have a $500,000 debt. It would depend on how much leverage you put on the property. So if you had a 50% leverage, in your example,
okay, but
you would have
would you be responsible for
If
the
you signed
amount
on the
that was
loan.
left over
yeah,
after it's all said and
from the
done?
creditor, from the bank, you would.
Okay,
Right. You would not be individually liable because you never signed on the loan.
okay.
Lender's gonna look to that signature.
He's first going to look to the property, and then he's going to look to the signature for any
Okay.
deficiency.
Stan, jump in here anytime you want. So Return Accelerator is a Western Investor Network trademark term. Really just I didn't invent this, just kind of put it on steroids a little bit, so we trademarked it. Allows an investor to syndicate or syndication to increase or accelerate your returns based on a core asset. Any asset with equity can be utilized to do this. Just need to be able to tap that cash or convert it to cash. The equity borrowed to invest in a non-traditional investment vehicle with above average returns. So that's where we get our acceleration from. Provides a return on top of it. Return is all it does, and I'm going to show an example of that here going forward. Basically puts us into a blended rate of return higher than the rate of return on your core asset. And it's really no additional work for the owners of the asset or the syndication. So this is a property that's listed right now. So this we looked at this a month or so ago. We didn't delve too deep into the due diligence or in the weeds on this. But I got some basic. This is a very generalized, rounded example to give you an idea of how the return accelerator could work on a specific property. This is around Arapahoe Road, so those of you that are working on Arapahoe Road with us probably drive by this all the time. 6 investors, I'm just going to use this as an example. We've got 6 investors coming into this. It's a $6 million property. We each put $1 million in. Okay, we're going to purchase it cash, obviously. We're bringing in that kind of money. The core asset return on that is selling and providing a 6.5% cap rate or yield. We would attach or borrow $3 million against the core asset. To pull that out right now, it's about a 5%. I'm rolling costs into that. It's 4.5%, 5.5%. Again, this is very general. Let's say it's to access that is a 5%. Nice round numbers. So we had our, oops, sorry, here's my corner. We had our $6 million asset, looking at 6.5% market return. We pull out $3 million at 5%. That $3 million we pull out, still churning up a 1.5%, and we still have the $3 million left in it at 6.5%. So we take the $3 million that we pulled out, and this is pretty simple type hard money loan, pretty easy to get in the market. So we got a 1-year term at 12%, 3 points. Again, this is very general, and there are going to be some costs with the sponsor involved in this. So the hard money loan blended rate. So our $3 million that we pulled out, returning 50% of the hard money loan, plus the 1.5, plus the 6.5 of the $3 million that's still in it. Formula for that and what that looks like is the 6.5%, which is still in there, or 3.25. The $3 million we pulled out, it's now at 16.5, and the blended rate of the 3.25 and the 8.25 would be 11.5. So you took your core asset at 6.5% and increased it to 11.5 just by doing what I'm going to say is a pretty easy hard money loan. So the next example I'm going to get into is if you did a non-performing note. So we've been doing a lot of non-performing note work, distressed asset type thing. I'm going to use a non-performing note here. So say we get that $3 million working at a 25% return. Now a lot of you are like, okay, right, 25%. I've hit these, I've hit 40, I've done 96% of them. It's out there, they're not easy to find. We go through numbers of deals before we find these. So 25%, we still have our 1.5% that's still in the deal, and then the $3 million that's still in the deal. So that pencils out that our 3.25 is still in there as before, 26.5 on half of it, 13.25, or 16.5% return. So you can see how if you hit these higher interest rates or returns, on the non-traditional assets, how it can really boost the blended rate, and you can still keep your core assets. So you have that property that you love, you don't want to sell it, it's free and clear, maybe you inherited it, maybe you had it for years, you got it paid down. This is a way to tap your equity, make a higher return, and still keep your core asset and keep it safe. Now, the way that we underwrite these deals, they're pretty safe. Hard money loans, we're going to be at 60% loan to value. So if we have to capture that property, we have to foreclose and take that back. We've got plenty of cushion in there to cover ourselves. Really, in our minds, same with the non-performing notes, we're not risking principal, we're risking return. So if we have to sell out of it, we're going to get our principal back. It's just a matter of if we hit a high return on it or not. Typically, we are. I have had one, to be honest, that was quite low. I went after the property, it's what I wanted. It didn't work out for me. It was less than 5%. But I have had some very high ones too. So this is going to summarize. This is pretty easy. I mean, it's not hard to understand. You know, you can get a core asset, utilize this return accelerator, or pull some out. Syndication structure, you set that up. Entity and manager, just like Stan delved into. He went way into the weeds on this. I'm not going to go into it again. Stabilize and manage the core asset once we take it. If it's something you already have, obviously that's already clicking along at you're probably 8 or 10% now because you're a little higher than the market rate because you have owned for a while. Leverage the core asset, $3 million as we talked about. Secure the investment, and relax. Let the sponsor collect that and make the distributions. And repeat the process. So that year gets over, you want to do another hard money loan, or if it's a year and a half or two to bring a non-performing note, you can do that over and over and over again. That is a summary and end of my presentation. Does anyone have presentations? Anyone have any questions on the return accelerator? Yes.
So your example started with a performing note at $6 million, and then you jumped to a non-performing note.
That's a property. That's
So-
an actual physical asset.
But the numbers were still the same there. Is it the same property? Is it a different example? So you started with the $6 million US bank.
Core asset, $6 million US bank triple net property.
Yep. Then you jumped to a non-performing note. But the numbers still seem to be $3 million and $3 million.
Right, so we got a $6 million core asset no matter what it is.
Yep. So that core asset starts there, but it's not performing.
It is performing.
It's two
It's
separate
performing at
properties.
6.5%. So that's where I got, just go back.
Yep.
So that's where I got 6.5%. So it's a performing asset at 6.5%. We're borrowing $3 million out of it because it's cash. We put all of our cash into it. So we can pull out some of our equity.
Okay.
And then that $3 million is what we're investing in a hard money loan or non-performing asset. So we still have a performing asset. We're just
What you
accelerating our
took
return
out,
on
you're
it.
going into a non-performing with.
Correct. So the $3 million is what the investment is. Or you can structure it any way you want, $1 million or 4. I think we could go up to 4.5 leverage on this at 25%, so we're 4.5 million. Okay. If you want to leverage it to the top. Some aren't that comfortable. So in a group or syndication, maybe 2 of the 6 don't want to leverage that high. They'd rather keep it 50-50. So that's just a decision that group needs to make.
Why not raise more money and not leverage it and not pay interest?
Why not raise more money and not pay interest? We've already paid cash for it. Maybe I don't understand your question.
Talking about maybe a hard money loan or buying a non-performing note outside
Oh,
of...
just keep the core asset at 6.5%? Certainly could do that. And you just go out and make a hard money loan. People do that all day. I do it. I mean, 3 this year.
Would that be in the operating agreement?
This is really, Kieran, if you have a core asset that you want to hang on to, or you have some equity and you really like that property, but you want to get a higher return on it, you can utilize this. Works great for that. As a syndication, yeah, you could just go out and do the hard money loans, but you don't have that core asset if that's what your group likes. Some people like to own real estate. Who's the other question?
Yeah, decide.
Ralph. Down, risky, but they're really not that risky. If they're underwritten properly, the loan docs are done well by an experienced manager who knows what he wants in his loan documents, they're really not sometimes, and most hard money loans are also recourse loans against the individual also.
So they would sign on it personally, you could go after them as well, and their other assets, personal bank accounts. AJ?
So let's say this scenario sounds great for me. I like the idea of syndicating with you guys, and the return accelerator also sounds pretty great. What would you say my timeline would be from start to finish to where I get 100% of my investment back plus all the return?
Well, where are we starting? Do you have an asset,
Well, let's-
or are you coming in on a new?
I think I want to syndicate my money with some, some
Okay, so you're
individuals.
coming in on a new syndication.
I'd like to have you guys manage the syndication, and then I think with the people that I'm with, we've decided that this return accelerator sounds great. So we'd like to go through that process as well. What would you say my timeline is on that?
That would be up to your group and how long the whole time you wanted to factor coming in. But 1, 3, 5 years, 7 years, hold on the core asset, 10 years, would depend on what we structured that to be starting off. And then the hard money loans, like we were mentioning, a year at a time, 18 months, there are different structures for those. Some could be as short as 6 months. So you could be rolling those return accelerator loans and hard money notes. Some of those workouts on the non-performing notes can be 2 years, can be 3. It just depends on the return that they're offering.
Now, let me give you an example, Jay. It would really depend on the asset that you're buying, your underlying core asset. If you were buying an asset that you thought you could ramp up rents over the next 5 years and then cash out at a cap rate on income in year 6 and really have a nice capital profit event, you maybe have a 5-year hold, but during that hold period, during that 5-year hold period, you could be rolling over your equity maybe as many as 4 or 5 times with a hard money loan. Most hard money loans are a year, some are for 6 months, just depending on the borrower, right? Usually they always have a yield lockout period of at least 6 months. So it just depends on what your core asset is. If you're looking at really capital appreciation in your core assets, but you want 5 years of increased rents before you sell at that cap rate, that's going to be your business plan, right? If you have a flip, if you will, something you say, well, I can go in there and make a lot of capital improvements to this property, we can flip it in a year, then maybe you won't want to do the return accelerator. But I think most deals, you'd want to at least take a look at the return accelerator. A type of deal that you might be looking at to get out in a year would be a development deal. There's not going to be any interim cash flow in the development deal, so you develop it, and in a year you're going to look to sell that to an investor, or maybe you're going to look to put permanent financing on it and go into kind of a cash flow type of investment. So it's really going to depend on what your core asset is.
Maybe give a couple examples of who would want a hard money loan, for what reason, and what risks associated. Well, you already mentioned the risk, so who would want it and for what reason, I guess?
Well, some of the ones I've done have been for someone borrowing against an asset that they have, and they want to take that money, pull the equity out and use it in another business or use it in another property. So we convert that, and they're having trouble with banks, so obviously they're not going to be stellar credit. That's why we look hard at the property, and we only do a certain loan to value on those. Construction loans, bridge loans, they'll do hard money for a short period of time. We've got a couple of those going with some developers on some bridge loans. So that's probably the 2 main ones.
Yeah, my experience has been over the last several years when you've had this tight credit market, it's just borrowers business people who are just not bank creditworthy. Banks' underwriting standards have been tight. So maybe their credit's been dinged from a prior bankruptcy or whatever the case may be. But we really look at the value of the property more than we look at the credit of the borrower. If he defaults for whatever reason, we're going after that property, and we know there's a lot of equity in the property. A lot of the borrowers, again, over the last several years have been marijuana guys. But an example that I had just recently, about, 8 months or so ago, this individual was in a lawsuit. He had an option to purchase a flex building. And the landlord tried to pull out of the option. So they had to go to court over the option. This particular individual won the lawsuit, and the court ordered the landlord to quitclaim deed the property to this new buyer. But because of the title work and because of all the legal aspects, it was hard for him to get title.
Investor want to like a certain amount of return, like a minimum. So you lock up the minimum, like for example, one minimum 8%. It doesn't matter the operational is profit or loss. The returns minimum 8%. Is there any law like that or
Minimum
Oh,
return?
sure. Minimum return.
or
Right.
depend on the profit and loss?
Well, it does depend on the cash flows, but when you go into one of these syndications, you're probably going to be buying a property if the manager or sponsor is offering a 6% preferred return, or what's the other term I want to use? Anyway, if you have a 6% preferred return, they're going to make sure, I would think, that they're going to be able to hit that 6% return either upon acquisition, or if it's a value-add property, maybe just a few months after acquisition. But that 6% doesn't have to be 6%. It could be 8%, it could be 10%. Whatever the sponsor is offering it with the particular investment. Same way with the waterfall. The waterfall could be 60-40, 50-50, or see joint venture offerings out there 50-50. Guys are trying to get 50-50. But
They're filling their pools, taking 50% on the back end. Guys that are doing that, groups that are doing that.
What if they don't reach the 6%? Maybe they lose money. The investor still get the 6%?
no, that's not guaranteed. The 6% is not guaranteed. So you certainly want to underwrite the investment and feel comfortable that that cash flow will be realized.
I have a question on preferred returns. Can you have in the equity piece of this, can you have or are you offering preferred return versus a common return, let's say? If someone says, okay, example is 500,000, I'll take 350,000. You get a preferred return versus the other investors who there's only 150 left, but I think it's a big portion there.
You can structure it like that. It gets a little bit more, esoteric if you can take one investor and offer them, preferred return of 50 or 10% as opposed to another investor who might be getting a preferred return of 6% or no return. That kind of gets into shares, an A share, a B share.
Yeah.
If you're going to offer a lot of different types of shares, which some groups do, but not really on the smaller syndication deals. You pretty much just stick with one share class, which is typically, we call it Class A investor share. The manager may be getting Class B shares. But what you're asking is, are there different types of shares that can be issued within the same group? And I think you could do that.
I've seen it.
Sure. Kind of like bonds, you could, preferred bond as opposed to, Yeah, you could structure it any way, sure. But what I see out there is sponsors try to keep this pretty straightforward and simple. But if you get into large investments, multi-million-dollar investments, you might see different classes of shares.
Any last questions?